envision the future of value investing in this new era?
Well, I'm glad to take that one. I think value investors are going to have a harder time now that there's so many of them competing for a diminished bunch of opportunities. So my advice to value investors is to get used to making less.
Charlie has been telling me the same thing the whole time we've known each other. I mean, we get along wonderfully because...
So we are making less.
Yeah, well, but that's because that mostly, I think, is because it's larger.
When we were younger.
But I would argue that there's going to be plenty of opportunities. New things coming along don't take away the opportunities. What gives you opportunities is other people doing dumb things.
How often do we get a warning before a storm? Rarely. But when Warren Buffett, the Oracle of Omaha, and one of the most successful investors of our time, hints at a financial catastrophe that could overshadow the housing crash of 2008, it's time to sit up and pay attention. What makes him think there could be a massive crash soon? Let's unravel Buffett's warnings piece by piece. And without further delay, let's get started. The temptation of speculative investments.
The 58 years we've been running Berkshire, I would say there's been a great increase in the number of people doing dumb things, and they do big dumb things, and the reason they do it to some extent is because they can get money from other people so much easier than when we started. So if that's done on a large scale, which it couldn't be done 58 years ago, you couldn't get the money to do some of the dumb things that we wanted to do, fortunately. So I think that investing has disappeared so much from this huge capitalistic market that anybody can play in, but that the big money is in selling other people ideas. It isn't outperforming.
The world of investment has been evolving at a blistering pace. But here's a figure that might leave you speechless. As of today, a mind-blowing $2 trillion is parked in cryptocurrencies. Now, let's roll back a decade. Cryptocurrencies were barely a flip on the financial radar, an experimental venture few have even heard of and even fewer understood. The growth trajectory from near obscurity to this towering valuation is nothing short of meteoric. So what's behind this explosive popularity of speculative investments? Firstly, the dream of instantaneous wealth. The media is replete with stories of early crypto investors turning their modest sums into fortunes. Stories of young millionaires made overnight from a timely Bitcoin or Ethereum investment, or those who caught onto the NFT wave early, have fueled the public's imagination. Such tales feed the notion that anyone can strike it rich, drawing in waves of eager, often inexperienced investors hoping to catch the next big wave. Secondly, curiosity and the thrill of discovery. Cryptocurrencies, for all their popularity, remain shrouded in mystery for many. They represent a new frontier of finance, away from the traditional banking systems, governed instead by blockchain's decentralized principles. There's an exciting allure to being part of something groundbreaking, even if one doesn't fully grasp its intricacies. Then there's the bandwagon effect. As more and more people talk about and invest in these avenues, the fear of missing out grips the masses. Nobody wants to be the one left out of the conversation or the profits. The snowballing effect of FOMO can inflate investment bubbles rapidly. However, Warren Buffett, with his decades of investment wisdom, views this landscape with wary eyes. He has always advocated value investing, or the practice of allocating capital on the basis of its expected long-term rather than its immediate value. According to Buffett, the frenzy surrounding speculative investments like cryptocurrencies and volatile tech stocks carries echoes of past financial bubbles. And like all bubbles, they're prone to burst. Buffett's cautionary stance stems from the inherent volatility of these investments. While the potential for gains is astronomical, so are the risks. The crypto market, for example, can swing by double-digit percentages in a single day. Such wild fluctuations can be stomach-churning for the uninitiated. Additionally, speculative investments, by their very nature, don't have a track record of stability. They're often driven by market sentiment rather than fundamentals. When sentiment shifts, as it invariably does, the cascading effects can be devastating. In Buffett's eyes, the massive influx of money into these speculative arenas without a clear understanding of their underlying value or mechanics might just set off a chain reaction in the financial world. And if this bubble bursts, the ripple effects could resonate through the global economy, much like falling dominoes. Skyrocketing asset valuations.
You're running small amounts of money. I think the opportunities will be greater. Charlie, wouldn't you? Will you budge an inch on that or not?
There is so much money now in the hands of so many smart people, all trying to outsmart one another and outpromote one another, getting more money out of other people. It's a radically different world from the world we started in. I suppose it will have its opportunities, but it's also going to have some unpleasant episodes.
Numbers, especially in finance, often tell a story. And the story unfolding from the stock market's $95 trillion total capitalization in 2021 is nothing short of breathtaking. To put that figure into perspective, it's like the combined economies of every nation, every industry, and every individual, and then some. At 125% of the global GDP, this astronomical sum is bound to raise eyebrows and elicit questions. The foremost question being, are these valuations rooted in reality? Warren Buffett, with his wealth of experience, has always championed the principle of intrinsic value. In essence, he believes in investing in a company based on its inherent, tangible value rather than market hype or speculation. It's about the fundamentals. How profitable is the company? What's the growth potential? How does it fare against competitors? Now compare this outlook with that of today's dominant technology firms. Their innovations have revolutionized our lives, and their growth trajectories have been impressive. However, when their stock valuations are held up against their actual profits, disparities begin to emerge. Some of these tech titans command market valuations that seem to orbit in different universes from their earnings. This disconnect is where Buffett's alarm bells start ringing. When stock prices soar based on speculation rather than grounded financial performance, they tread on unstable terrain. Remember the dot-com bubble of the late 90s? The euphoria was evident, with tech stocks seeing stratospheric rises. Yet when the bubble burst, it led to significant financial turmoil. Buffett warns of a similar scenario today. The inflated valuations, particularly in the tech sector, have created a fragile financial framework. The danger is not just a correction in these stocks, but a chain reaction that could ripple across sectors, regions, and economies. In Buffett's words, it's a ticking time bomb. When or if it detonates, the fallout won't be just confined to individual investors or companies. The ramifications could be vast, echoing through the global economy. As market enthusiasts continue to ride the valuation wave, one can't help but wonder, are we sailing towards a monumental crash? Only time will tell. Mounting global debts. By the year 2022, the world's debt had ballooned to an unprecedented $281 trillion, equal to more than 355% of the global GDP. Such an immense sum is almost unimaginably large. To understand the gravity of the situation, imagine every man, woman, and child on Earth owing approximately $36,000. Now, when nations, corporations, and individuals are so deeply mired in debt, what does it mean for the global economic landscape? Warren Buffett, with his signature expertise and foresight, has always been circumspect about heavy leverage. Debt in moderation can be a potent tool to drive growth and expansion. However, unchecked and rampant borrowing is similar to playing with fire, especially when the underlying fundamentals are weak or the borrowed funds are directed towards unproductive avenues. The present-day scenario is particularly concerning for several reasons. First, a significant portion of this debt is held by nations. Countries like Japan, the United States, and parts of Europe have staggering national debts. Such colossal state debts can hamper economic policies, constrict growth, and increase vulnerabilities to external shocks. Then there's corporate debt. Because of low interest rates, a lot of businesses have taken on too much debt. While this might work in booming times, A downturn or an increase in interest rates could squeeze these corporations, leading to potential defaults, layoffs, and broader economic consequences. But what really amplifies this debt dilemma is its timing. We are in an era marked by geopolitical tensions, potential interest rate hikes, and an ever-evolving pandemic scenario. Any of these factors could strain the global financial system. And with the added weight of $281 trillion in debt, the system's resilience is in question. It is clear what Buffett thinks about this. The huge amount of debt around the world is a silent threat. It might not create daily headlines, but its very presence can sway global dynamics, threatening economic stability and progress. A debt crisis could have a lot of effects that spread to other areas of the economy, not just Wall Street. One misstep and the fall could be sudden. The illusion of endless growth. Economists and stock analysts often sing praises of infinite growth, a seductive tune that promises an unending upward trajectory. In 2022, despite the myriad challenges, global economies aimed for a 3.5% growth rate. But is it realistic to expect economies to grow perpetually without facing the repercussions of overextension? Warren Buffett, often seen as the North Star in the financial cosmos, challenges this very notion. He posits that while growth is essential for progress and prosperity, the idea of infinite growth is more of a mirage than reality. First, let's figure out why this notion is so pervasive. Continuous growth paints a picture of prosperity. For companies, it implies higher stock prices. For countries, it suggests better living standards. And for investors, it translates to more substantial returns. It's a proverbial golden goose. But as history shows, every growth curve encounters inflection points. Economies are cyclical after all.
Trying to outsmart each other in arenas that you don't have to play. I mean, the world is overwhelmingly short-term focused. And if you go to an investor relations call, they're all trying to figure out how to fill out a sheet to show the earnings for the year. And the management is interested in feeding them expectations that will slightly be beaten. I mean, that is a world that's made to order for anybody that's trying to think about what you do that should work over 5 or 10 or 20 years.
The inherent risk with chasing perpetual growth is that it can lead to unhealthy practices. Companies might take on exorbitant risks, banking on future growth to cover present excesses. Nations might overspend, hoping future economic expansions will balance their books. Investors who are blinded by the promise of exponential expansion may risk their money on businesses with weak foundations. Buffett frequently refers to the late 2000s housing bubble as an illustrative example. There was a collective belief that housing prices would perpetually rise. This assumption led to reckless lending, over-leveraging, and a catastrophic crash. The principle is clear. Growth, when pursued blindly and without a sound basis, can lead to a profound crisis. Another dimension Buffett emphasizes is sustainability. In our pursuit of ceaseless growth, are we considering the environmental, societal, and long-term economic implications? Can our planet sustain such growth without depleting its resources? In Buffett's playbook, sustainable and well-calculated growth trumps unchecked expansion. In the complex theater of global economics, it's imperative to discern between genuine, substantial growth and the mirage of infinite expansion. The latter, as Buffett cautions, could be a path fraught with peril. The disconnection from real-world value.
I don't really understand it. I think it's an incredible technological advance in terms of showing what we can do, but I don't know whether we know what happens. And I was listening, who was it the other day that was, who knows a lot about technology? He just says that, it scares him. Well, if it scares him, it scares me in terms of the possibilities of it. I mean, we've done amazing things, like we figured out how to create an atom bomb back in 1945. I didn't know what an atom was or anything, but Einstein told me it was going to change the world, and it changed the world. So I don't want to change the world too many times without having some idea of the consequences of it. And I think this is extraordinary, but I don't know whether it's beneficial.
In an era where a single tweet can send stock prices soaring, and where digital artwork can fetch millions, it's evident that traditional notions of value are being challenged. The market cap of some tech giants has surpassed the GDP of sizable nations. But is this reflective of real-world value? Or are we witnessing a detachment from real assets? Warren Buffett, whose investing philosophy is deeply rooted in identifying intrinsic value, finds this trend unsettling. For him, the essence of an investment lies in its ability to produce goods, services, or returns that possess tangible worth. This disconnection from real-world value, according to Buffett, is one of the potential pitfalls in the current economic environment. Let's break this down. Historically, the value of a company was closely linked to its assets, its products, its services, and its profitability. Today, while these factors are still significant, other elements like brand perception, online presence, and even speculated future potential can widely inflate a company's valuation. Take, for instance, the boom in tech startups. Many of these firms operate at losses for years, with valuations based primarily on future potential rather than present value. Similarly, the surge in popularity and value of non-fungible tokens, or NFTs, baffles many traditional investors. Digital art pieces, without physical presence or utility, are being auctioned for astronomical amounts. While proponents argue that this is the future of art and collectibles, skeptics, including Buffett, question the lasting value of such assets. This detachment from tangible value isn't just a philosophical debate. It carries real-world implications. Overvaluation can lead to bubbles, and when these bubbles burst, they can wreak havoc on economies, as seen with the dot-com bubble of the late 90s and early 2000s. Buffett's contention is simple. When investments drift away from real-world value, they become speculative and volatile. This volatility might offer opportunities for short-term gains, but can be detrimental in the long run. An economy built on speculation rather than tangible value is like a house of cards, vulnerable and unstable. In this rapidly evolving financial landscape, Buffett's words serve as a reminder. While innovation and change are inevitable, grounding investments in real-world value remains paramount. It's a compass that can guide investors through the turbulent waves of modern economics, ensuring stability and long-term growth. Warren Buffett's insights make us pause and think about our financial future. Do you agree with his predictions? Let us know your thoughts in the comments. Is a big crash coming, or is it just another bump in the road? We'd love to hear from you.